Good evening, ladies and gentlemen. Welcome to Reference Point. I'm your host, Dave Coker-Hook. This evening I have a repeat guest, a gentleman that's actually been on my show probably 4 or 5 times in the last several years, Narbik Karamian, who is with the Bennett Group. And he's involved in the mortgage lending industry. And what's significant about this is that each time Narbik has been on my show, we've talked about a topic tied to what's going on with home mortgages, with the downturn in that industry, and the problems with trying to find refinancing or loan modification, et cetera, et cetera. And each time we were a little bit ahead of the curve of what it was that actually came to pass, and Narbik had been spot on with telling us some of the things that were going to happen. So Narbik, it's a pleasure to have you back on my show, and hopefully we'll have some other exciting news to tell us today.
Thank you, Dave. It's good to see you too. So, yeah, I remember the first time back in 2007, August, we had our first little thing here, and we predicted the crisis of the 2008, the financial crisis, and we saw what happened then. So, but a lot has evolved since then. So
right, and we talked about a number of different things. There was that tied to the adjustable rate mortgage things and the subprime stuff that was going on. And we had another show where you were talking about loan modification and some of the opportunities that were there. Now that was a tough situation. There were some really challenging things going on for people who were looking to try to take advantage of what the government was putting forward. But my recollection is that the banks had certain criteria that they were trying to judge things by that didn't really match up to what the real world demanded at that point.
Well, the anticipation was to allow 4 to 5 million people to qualify for loan modifications. But the HAMP program, which stands for the Home Affordable Modification Program, only was able to approve 500,000 people.
Wow.
So it didn't go as planned. But in conjunction to HAMP, there was another program that was launched called HARP, the Home Affordable Refinance Program.
HARP, Home Affordable Refinance Program. Sounds good. You think of HARP's nice, angels helping you out and stuff like that.
Well, that was the plan, but ironically, the focus was more on HAMP rather than HARP. But in the long run, HARP ended up benefiting homeowners by far more than HAMP did.
What exactly is this program? Say it again.
Home Affordable Refinance Program.
Home Affordable Refinance Program. What exactly is that, and what does it mean for a homeowner who may have had that? Before you get into that, one of the things that's interesting about Northern California, San Francisco Bay Area, where we happen to be, is that the little micro communities, some of our communities in this area have had almost no negative impact by virtue of the downturn in the housing market. Others have been devastated by it. And so this program, this HARP program, what is it intended to accomplish, and how is it supposed to work?
Well, HARP was launched initially in 2009 with the intention of helping homeowners who had mortgages that were underwater to be able to refinance just like anybody who has enough equity in their homes.
Okay.
So that was the intention. But originally, back then in 2009, there were so many restrictions that it really prevented people from qualifying, and it just disqualified them from the very get-go.
When you say restrictions, are these guidelines that were put into the program by the government at the time when they initiated the program, or were they tied to the banks that were the holders of the mortgages?
Well, it was discretionary. So it was ultimately
discretionary.
It's always been discretionary, though the government has tried to enforce it as much as possible. But you reach a point where you cannot, go further by enforcing these regulations. So they were discretionary. But some of the requirements or the criteria that prevented homeowners who had mortgages that were underwater to qualify was there was a limit on how much you could be underwater, and it was 125% under HARP 1.
125%.
That means,
so what's that mean exactly?
That means if you had a mortgage for $500,000, if the value of your home was less than $333,000. That's actually $625,000. I'm trying to put these numbers together.
Okay.
So if you have a mortgage for $625,000 and your property was worth $500,000, you could qualify. But if it had dropped less than that, you wouldn't qualify. So there was a cap, and that was 125% cap.
So what they did is they said, whatever my current value of the home is now, as far as what the market conditions say, if my original loan was 125% or less of the current value, then I could have qualified.
Correct.
But in certain communities around here that really got hammered, like out towards Stockton and Tracy and that part, and some parts of San Jose actually too, they lost 50% of the value of their homes.
That's correct. So that was one of the biggest restrictions that pretty much eliminated a big group of people who couldn't qualify.
Right.
The other restrictions were under HARP. There were a lot of expenses and costs incorporated into that, and those costs did not justify to refinance the home, because at the end of the day, the savings wasn't, well, the costs connected to the refinance did not justify the savings.
The costs to whom?
For getting the loan to refinance.
The costs to the consumer, to the
well,
homeowner?
the cost for the, yes, exactly. The cost to the consumer in order to get the refinance.
So there were certain fees that they were going to have to pay as part of going through this program.
HARP program, which was more than what normal refinance programs, the cost for normal refinance programs. So there were restrictions there, and then there was another restriction where the servicer had, and this was the biggest killer in qualifying for the HARP 1 program, and that was you could only refinance through the same servicer. Servicer meaning the company that sent you the mortgage statements.
Okay.
So if you received a statement, every month, your mortgage statement through Wells Fargo, then you could only refinance through them. Or if it was Bank of America, you were only, allowed to refinance through them. And since it was more like a monopoly, then it was to the discretion of the bank, and they knew there was no competition whether they would accept the refinance or not.
Why should they do it?
Right. But there were also other servicers who were not lenders. Companies like Ocwen and Litton Services, EMC, and those guys, they did not actually provide financing. So if your servicer was one of them, then you were actually out of luck. You couldn't do anything.
Because they couldn't rewrite
because they were not lenders. They were just simple servicers.
Interesting.
So these were the restrictions under HARP that prevented a lot of people from qualifying. But in December, in December of 2011, they refined HARP 1 and they created HARP 2.
HARP 2.
Which is the refined version of HARP 1.
Okay.
But I have to say, and I haven't said this in your show, this is one of the programs where I personally feel is going to allow homeowners to truly qualify and take advantage of them. Because there's always been glitches in these programs that the government has come out with. But this particular one, I strongly believe, is to the benefit, or is designed to benefit homeowners who haven't been able to refinance.
So have they addressed some, if not all, of the problems that you identified that were part of the HARP 1?
That's right. So the first one we talked about, HARP 1, where the servicer had to be the same.
Right.
They've totally eliminated that. So you're free to pick whoever you want as your lender to apply for a HARP refinance.
So that opens the field toward market competition.
Right.
Which is good because
you can shop.
You can shop. And many of these banks are looking, or servicers, whatever the proper term is, they're looking to bring more business to themselves. And even if it's at a slower principal or smaller interest rate, it's a loan they didn't have. And if they can pull it in, it's to their advantage.
And it's backed by the government. There's really less risk involved. The other restriction that they took away from HARP 1 in HARP 2 is that there's really no more restriction as to how much underwater your house can be.
So the 125% thing isn't there anymore.
Right. So there are some lenders, again, since it's a little is discretionary, they have come up with a cap. But at this point, since it's new in the workings, it's 150%. But under the government guidelines, there's really no restriction. So you can be underwater. Of course, I'm sure they've done the calculations and they know what the maximum, negative equity in the country can be. So
as far as what the average,
exactly,
like that. Yeah.
That's right. So they've removed that, which I think is a big contributing factor to open up more possibilities for homeowners to refinance.
Well, good. One of the things, Narbik, that was we had talked about this on an earlier show, the one where we were discussing trying to find mortgage modification. And at that time, the banking industry was saying that the only way that they would engage with a homeowner is if they were 3 months or more in arrears on their payment, which of course creates a very negative credit report situation for them. And so there's a lot of people that were put in a position where they really wanted to try to do something, and that was the only avenue open to them, and so they went down that path. So what's the impact for some of HARP 2 for that kind of a situation? Because I'm sure there are some folks out there that ran into that.
Yeah. Unfortunately, for folks to qualify for HARP 2, one of the requirements is that they cannot have a late payment on their mortgage in the past 6 months. Though they're allowed to have one late payment in the past 1 year. So, so the most recent 6 months, there cannot be any late payments, but the 6 months prior to that, you're allowed to have one late payment. But for folks who were encouraged to be late on their mortgages and who took the route of HAMP, which is the modification approach rather than the refinance approach, that's where it backfired, because right now there's really not much as far as programs out there for unfortunately for these folks. But
when was that part of what I'm wondering is, you've mentioned you can't have any missed payments in the previous 6 months and only one in the previous year, but some of the home modification programs were being looked at back in 2010.
Correct.
Which is well beyond a year ago. And so if someone went 2 or 3 or 4 months, whatever, in 2010, and then just went back on the process of making payments, they would not have that one.
Because they would fit the criteria.
They would fit the criteria. Okay.
Okay. Yes, they would. And again, this is it's up to Fannie Mae and Freddie Mac to decide whether they would honor that. But that's an area where it's open to, I guess,
interpretation. Yeah. Okay. So it's a gray area, as they say. A gray area.
In reality, what happens is, we know when people have more than 20% equity in their homes, they are entitled to any regular kind of refinance. It gets difficult when you have less than 20% equity, and this is where HARP 2 comes in to fill this gap. So we know that there's unlimited negative equity you can have to qualify for this, but from this side, you can also have up to 20% equity in your house and still qualify for HARP. So wherever the regular refinance, I guess, does not apply, HARP 2 kicks in to pick up that.
Let me see if I understood that correctly. So if you own your home and your original mortgage was
$100,000.
Yeah, that's easy. That's easy to work with. It's a small number, but it's in this part of the country. But say it was $100,000. If the current equity you have in your home is 20% or $20,000 or more, you can or you cannot qualify for the HARP program.
So if you have less than 20% equity, you qualify for HARP.
If you have less than 20%.
But if you have more than 20% or more, then you qualify under standard refinance. Because there's no need for a HARP.
Oh, I see. Because a lot of people, when they bought their homes, but we look at this, the mortgage bubble burst in when
August 2007.
August 2007. And so from that point on, there were a lot of people that were buying properties up to that point in time. You know, and it was just in our community, there were some very high values on properties, and people were getting into them for, almost nothing down, right?
It's a good definition of a balloon.
A balloon
situation.
Right. So they had no equity, or very, very little. So, okay, so this program, the new HARP program, can help those people who were in that type of a situation, who were encouraged to take advantage of the free-flowing circumstances of the day.
So, there are 4 criteria to meet in order to qualify for HARP 2, and I think if we can cover those, it'll be a good, I guess, cheat sheet for the viewers to follow to see. So one of them is that, as I mentioned, there cannot be any late payment. they cannot be late, or you cannot be late on your mortgage within the past 6 months, though you're allowed to have one late payment within the year.
In the last 12 months. Okay.
The second criterion is that the mortgage has to be taken, or the mortgage has to be securitized before June 1st, 2009. This is very important, because that's when HARP was introduced, and they believe that mortgages that were taken, or loans that were taken after that, really were able to take, people were able to take advantage of lower interest rates.
Oh, right.
But prior to that, if you remember, during the subprime or the Alt-A crisis, there were homeowners who had 6-7% mortgages.
Right.
So that's the cutoff period, the June 1st, 2009. And if your mortgage was taken before that, that's, you do meet that.
Then you can qualify, okay.
Right. The third one is that the mortgage that you have needs to be owned or backed by Fannie Mae or Freddie Mac. And this is the question I get in my in day-to-day operations, is how do I know whether Fannie Mae or Freddie Mac owns my mortgage?
Okay.
There are two links, and if we can, if you can easily go to the Fannie Mae and Freddie Mac website. I don't know if we're able to show this link.
I'm sure we've got them. We'll put them up while we're talking about. What I'd like to do is I want to go back and talking more about the Fannie Mae Freddie Mac scenario, and we'll put the links up as you discuss that, because I think there's a couple other things about that you want to tell me. But tell me what the fourth criteria. Let's identify the four criteria, and then we'll go back and dig into
And the
them.
last one, again, we already talked about, is you must have less than 20% equity in your home.
Okay, so we have four things. You can't have missed a payment in the last 6 months. You could have missed one in the last year. Your loan had to have been acquired prior to, what was the date?
June 1st.
June 1st of 2009. So if you bought the home prior to that, you could qualify for this. The third one is that the mortgage had to currently be owned by Fannie Mae or Freddie Mac. And the fourth one is you have to have less than 20% equity in the home.
Because if you have more than that, you're entitled to a regular refinance, so HARP wouldn't apply.
So let's talk about the Fannie and Freddie thing, because don't Fannie and Freddie just about own everything these days?
They own the majority of the mortgages these days. Of course, they securitize them and they still sell them as mortgage-backed securities. But one thing I think it's worth mentioning to our viewers here is that if they receive a mortgage statement, or if they receive their mortgage statement from Bank of America or Citibank, it doesn't mean that Citibank, Wells Fargo, Bank of America are the owners of their note. They're called servicers. Because Fannie and Freddie do not have the means and the resources to do the administrative work. So they hire the banks or other servicing companies, as we mentioned, like Litton and Ocwen and EMC and those firms to do the administrative stuff for them.
Okay.
So it's important for homeowners, if they want to see that they do qualify, or if their mortgage is owned or backed by Fannie and Freddie, to go to their website. And it's a very simple website. You just type in your address and your name, and right there on the spot it tells you actually whether Fannie Mae owns the mortgage, and there's a separate link to Freddie Mac's website.
Okay, so I know the guys are going to be putting that up on the screen right now, but let me ask you about this. So you put in the address of the property, and it will identify who the owner of the mortgage is?
Well, no, it will only say whether Fannie Mae owns that mortgage or not. So, so there are two separate websites. One is for Fannie Mae, and the other one is for Freddie Mac. So you have to go to two separate websites, and as long as one of them is the owner.
One or the other. So you go up to the Fannie Mae and you put the address of the property.
The address,
and it'll tell you whether or not Fannie Mae owns the mortgage on that one. And you go to Freddie Mac. If it's a no, you go to the Freddie Mac site and they'll check that out, and
hopefully
it'll say yes or no. And if it's in either one, then you're going to be able. It's one of the qualifying factors for the HARP program.
That's right. So
and if it isn't, then
that becomes a different story. But again, in February 2012, there was a settlement between the government and 4 of the nation's largest banks. And this was a $26 billion settlement.
Okay.
Where the banks agreed to allocate these funds to further help homeowners to proceed with their loan modifications or to qualify for HARP. Now, from that $26 billion, from my information I've gathered, between $6 to $12 billion is going to be allocated to California.
Now, is this? I recently saw something about Bank of America. They're putting all these notifications out about how they can get mortgage reduction program and stuff like that. Is this what you're talking about here?
It's part of that settlement.
Ah.
So, in reality,
so the government came and said, "Look, you guys have been screwing up. You need to do something about it. Put some skin in the game and help these people out." Basically,
right. It's either fix it or we'll pursue the matters in different ways.
Oh, you're very discreet. Nicely put.
But that's so, and we see the impact. So, if only 500,000 homeowners qualified for the modification program, where the intention was 4 to 5 million, I think we're going to notice more homeowners qualify for the modification, program, and then I think we're going to see a lot more HARP.
So the modification. So what that means for our listeners out there is that if they go up to, if they go and look at the 4 criteria that we talked about, I'm not going to name them again, but let's name them again.
Yeah.
If they've got
20% equity or less
than 20% equity or less, if it's owned by Fannie or Freddie, if they have not been late on payments.
Right, and the June 1st.
And they got the mortgage prior to June 1st, 2009, then the HARP program is potentially very, very good for them.
Correct.
Anything after that, the HARP program isn't applicable to, but these new initiatives that are present from the major banks by virtue of government pressure
and the settlement, right,
is going to offer those folks the possibility of a modification.
That's right, and we're already seeing it. I'm hearing from here and there that we received a call from our lender asking to to help, and we didn't see this back in the days where modification. It was the consumer who had to constantly contact the lender,
right?
And they were given the runaround. So we've heard a lot of nightmare stories, and we talked about this in one of your earlier shows. And I think it all boiled down to the fact that it was discretionary.
Right.
And the government had no, but at this point where they have reached a settlement, I think this is going to work out well for California, because California was one of the hardest hit areas in the country as far as the mortgage meltdown.
So this is good news for homeowners, is what we're talking about.
Absolutely.
Okay, good. So, are there any other major points here or criteria? And we've talked about HARP 1 and HARP 2. Didn't you tell me there's some other refinements coming down the pike?
Actually, it's in conjunction with HARP with the settlement we just talked about.
Okay.
So if you remember, we mentioned that under HARP 2, still the Fannie Mae and Freddie Mac have to be the owners of these mortgages. But under the settlement we just discussed, it's come to the agreement where even if Fannie and Freddie are not the owners of the mortgage, and if it's owned by any of these banks, they will still honor the HARP program. And that's where rumors have it that HARP 3 is coming out.
Okay, so this isn't official yet, but it seems to be moving in that direction?
If you
one of the things about what we're talking about that is gratifying to me, over the last several years when this condition hit, the housing bubble burst, the horrible impact on the economy. It's been so difficult for a lot of people. I mean, just people, I'm sure you have friends and family and just folks that that have been impacted. I know I do.
Of course.
And it's just, it's been really a challenge. And I know that we've tried a number of things as a country, the government has tried a number of things to try to to fix it. What it sounds like to me is that they haven't stopped trying, and they realized that we went down this path and it just wasn't getting what we thought we were going to get, so let's change the things a little bit, and so they're finally reaching a point where there's a viable solution for a majority of the people, as opposed to a small minority of the people who have been impacted by the bubble burst.
Now, I think that HARP 2 is the best alternative that was created after the mortgage meltdown. I am very comfortable about that, because I see this in my day-to-day operations. The volume of homeowners calling us and wanting to see if they qualify, and we're comfortable to say that more than half are now qualifying, while before these before a couple of months, until a couple of months before they wouldn't have a chance to qualify. So I see what it's going in the right direction.
Going in the right direction.
The only sad part is people, the HAMP program, which was the modification program, didn't turn out to be as strong as the HARP.
As we had hoped. So what do you see in the way of the evolution of the market, the housing market? It's been at a kind of, it's gone down and it's sort of hovering and maybe up a little, maybe down a little, depending upon what community you're in. But in general, what are your impressions of the current status of the market, and where do you think it's headed?
Well, I always believe that California, especially the Bay Area, has its own ecosystem. We've always been the exception to the rules here. And I've also noticed that if we were the first to recover and the last to be hit. And we're seeing this right now. Obviously, there's so many high-tech companies in the area. Some are going IPO. One went IPO today, Facebook.
Right.
So that's created a lot of demand for real estate. And we know that inventory isn't as much as even where it was maybe a couple of months ago. So it's a demand and supply formula. It doesn't matter what happens to the market. If there is a demand for a good, in this case real property, then the chances of depreciation becomes less. Though this is not the case throughout the rest of the country, there are still states that have been unfortunately hit hard, and they're still recovering.
Some challenge.
But overall, even in the areas that really got hit hard, like Stockton, those areas are starting to recover,
which is fantastic.
Which is, yes.
Narbik, we're just about out of time, but I'm going to ask you one other question here, and that is, if an individual owns property in other locations where they might be rental properties, are they able to qualify and those properties have that issue, are those properties able to qualify for the HARP program? They
HARP,
are.
yes.
Which is fantastic.
As you can see, HARP 2 is a lot more lenient version of HARP.
That's fantastic. Well, we've actually reached the point where we've run out of time again. I mean, every time we do one of these shows, I wish it were longer, but we've run out of time. I want to thank you for coming back and being on the show again. Ladies and gentlemen, the information that we just talked about regarding the HARP program, I hope you paid attention to that. We tried to make it non-technical and to give you information that can help you or someone you know who may be in a situation where they're underwater with their home mortgage. So, Narbik, I want to thank you again for being here. It's always a pleasure to have you on the show. Ladies and gentlemen, don't forget, if you have any questions about this topic or any other topic we discussed, send them to me at info@referencepointtv.com. I should have said that earlier, but send them here, info@referencepointtv.com. We'll get those questions to the right party, get them Narbik or whomever, and we'll get them answered for you. So, appreciate your tuning in, and we'll see you next time on Reference Point.